If your mortgage renews this year, your payment is probably going to go up by about $500 a month. Not eventually, the day you sign. Here's the math. If you bought in 2021 with a $500,000 mortgage at 1.9%, which was totally a normal rate back then, your payment was probably around $2,090 a month. Your balance at renewal is going to be about $418,000. And if you're renewing at today's rates, let's call it 4.2, your new payment is going to be about $2,570. That's $476 more every month for years. I'm Janine, I'm a CPA, and in the next 10 minutes, I'm going to give you the exact playbook on whether to go fixed or variable, what term to pick, and how to negotiate like the banks negotiate. First, 30 seconds or so on the mechanics of your mortgage, because your bank is counting on you not knowing this. When your term ends, usually after 5 years, your mortgage does not disappear. The remaining balance renews at whatever rates are at now. And here's the part that matters in 2026. Hundreds of thousands of Canadians locked in 5-year fixed-term mortgages in 2021, when rates were between 1.5 and 2%. Those all come due this year and next. And this is the single biggest consumer financial event happening right now in Canada. About 4 to 6 months before your renewal date, your lender sends you a renewal letter with an offer. Here's what they don't advertise though. That first offer is almost never their best rate. It's the rate they hope you'll sign because switching will feel like a hassle. And one thing that surprises people at renewal is that you don't have to re-qualify with your current lender. There's no stress test, no income verification. They just send you the paper. That's convenient, but convenience is exactly what you're overpaying for. We'll fix that in the negotiation section. Okay, decision number 1, fixed or variable. And I'm going to give you actual 2026 context, not generic advice. So this is where things stand right now. The Bank of Canada has held its overnight rate at 2.25% since October 2025. Now, bank prime rates are around 4.45%, which means 5-year fixed rates are running around 4.1 to 4.6%. However, 5-year variable rates are sitting at about 3.35 to 4.55%. So variable is cheaper today by almost a percentage point. Tempting, right? But here's the catch. Inflation came in at 3.2% in May. This is some of the highest inflation we've seen since 2023. So some forecasters are warning that rates could go up from here, not down, potentially by as much as a 1/4 point. And maybe even a 1/2 point through 2027. Variable is betting that they are wrong. So here's my CPA framework, and it's not about predicting rates because I can't see into the future, and actually nobody can. Choose a fixed rate if your payment increase would genuinely stress out your budget on a monthly basis. You are buying certainty. In a year when your payment has already jumped potentially 20+%, certainty has real value. There is no shame in paying a little bit more to sleep well at night. Choose variable if you could absorb your payment rising another $200 a month without touching your emergency fund. And you actually believe you won't panic lock in at the worst possible moment, because that is what tends to happen to variable rate holders. They convert to the fixed rates after locking in the rise. They convert to fixed rates after rates rise, which is ultimately locking in the loss. The question isn't which rate is lower today. It's which risk can my budget actually carry? Okay, the next decision you need to make is how long to lock in for. Everyone tends to debate fixed versus variable, but almost no one is talking about the more interesting question, which is how long. You don't have to take another 5-year term. You can take a 1, 2, or 3-year term. And in 2026, shorter terms are a legitimate strategy. Here's the trade-off. A shorter term can cost a bit more in rate, but not always. What you're buying is optionality. If rates fall over the next couple of years, you'll get to renew again sooner and catch the lower rate. If you lock in for 5 years at 4.4% and rates drop to 3.5 in 2027, you're stuck, or you're paying a penalty to break. But be honest about the other side. If rates rise, that short term means you renew again into something worse. You're paying extra today for a lottery ticket on lower rates tomorrow. So there are kind of 3 different ways you can look at this. There's the 5-year fixed. You want to stop thinking about everything that's going on, and that is completely valid. There's the 2 or 3 year fixed rate where you think rates are near their peak and want the option to renew at a potentially lower rate. This is a popular bridge strategy right now. And then there is the option to do a 1 year rate, which you would only do if you're really planning on selling or you have a really specific reason to stay flexible. Otherwise, there's usually a rate premium that goes along with this, and it isn't worth it. One more thing to mention. Match your term to your life, not just the rate. So if you're planning on moving in 3 years, please do not sign a 5-year term mortgage. The breakage penalty on a fixed mortgage can be really expensive, and that is a video all on its own. So comment below if you want me to dive into that next. All right, next up is how to negotiate these rates and terms with your lender. Here's what I want you to take notes of, because this section is worth hundreds of thousands of dollars. Step 1 is start at least 120 days out. Most lenders will let you hold a rate for 90 to 120 days. Set a calendar reminder for 4 months before your renewal date, and do that right now, especially if you're inside that window. The second step is to get real about competing quotes, not rate site screenshots, actual quotes from financial institutions. The fastest way is through a mortgage broker. They're paid by the lender, not you, and they shop dozens of different lenders at once, including ones that you've probably never heard of that consistently undercut the big 5 banks. So I want you to talk to your bank and your broker, always both. Now, step 3 is make your bank compete. Call your lender, ideally the retention department, not the first person who answers, and say that you have another offer from a different lender. You can note that you'd rather stay, but you would move for this rate, and can they please match it? Banks do have discretion. They will never volunteer this information. The renewal letter rate is their opening bid. And step 4, know that switching is easier than you think. At renewal, transferring to a new lender usually has no penalty. You are between terms, but you will need to requalify with that new lender. And there may be a small transfer fee or appraisal fee that many lenders will actually cover if you ask. Step 5 is negotiate more than the rate. Prepayment privileges, which is how much extra you can pay per year without a penalty, prepayment frequency, and portability are all things that you have the ability to negotiate. A 15% prepayment can be worth more than 5 basis points on a rate, depending on your plan. So here's your mortgage renewal playbook in order. 1, find out your renewal date right now. It's in your mortgage documents or on your banking app. Now set a reminder for 120 days before. Step 2, decide your risk budget. Before you look at rates, could you handle another $200 increase? That answers fixed versus variable. Step 3, get at least 2 quotes, your lender and a broker, and make them compete. And step 4, pick the term that matches your life plans, not the rate table. If your renewal is in 2027 and you're wondering whether to break your mortgage early to lock in today's rates, that penalty math can be really expensive. And for 1% or less, it likely isn't worth it. But again, I'm happy to dive into that in another video. Just let me know what you want to see in the comments section below. And don't forget to subscribe to my channel so that you never miss a video.